Yeah, we always like to end on a positive note here. So first off, we'll start with the dog of the week. Like Ryan said, Simulation Plus, symbol SLP on the NASDAQ. And it's just fallen quite dramatically over the past year with a sharp decline after the fiscal Q3 earnings, which is what we'll focus on in this segment. But the stock is down 70% over the past year. It hasn't been great, with a 26% drop after the fiscal Q3 earnings. It's trading at $12.97 a share. That's a 261 million market cap at this time. And if you aren't aware, Simulation Plus is a leading provider of informatics, biosimulation, simulation-enabled performance and intelligence solution, and medical communications to the biopharma industry. In addition to software sales, the company also offers consulting services. The revenue split between the two is about 60% software, 40% services, and that's for the year to date so far, but it kind of hovers around that 2/5, 3/5 figure. So why has the stock dropped just so much? First, let's just go back only about a month to June 11th. The shares dropped significantly as the company announced a lower guidance for the fiscal 2025 and preliminary fiscal guidance for 2025, as well as preliminary revenue for Q3. For Q3, the company announced preliminary revenue of 19 to 20 million, well below the consensus on the street at the time. And then for 2025, guidance was cut to only 76 to 80 million, when the prior guidance was 90 to 93 million. Following that announcement, the next day, because it was released after hours, the stock fell 24.6%. Big drop effectively in one day just because of the preliminary earnings. Now we move on to the Q3 earnings in full. Revenue actually came in above the preliminary expectations at 28.4 million, 10% growth. But that includes the acquisition of Proficiency. And without it, organic revenue actually declined by 4%. So organic decline. So obviously not great. The top line growth was actually driven as well by a 17% increase in their medical communication services, but the other services declined and were just generally weaker than expected, with management attributing the decline to cautious spending behavior, project delays or cancellations from biopharma clients, which can be further attributed just to general market uncertainty around future spending, drug pricing, tariffs, policy changes, because there's been a bunch of shifts in the FDA where that's going to really come out. You don't want to pour in a ton of money into research when you don't know what the outcome is, if it's going to be viable by the end of the year. But gross profit came in at 13 million, a margin of 64%. However, the company had a massive net loss at 67.4 million, 335 a share, due to a one-time non-cash impairment charge, non-cash, I want to emphasize that, of 77.2 million, to align the book value with the actual market value of their assets through intangibles of what they've acquired previously. A massive impairment, given that is in the range of their fiscal 25 guided revenue. Just to give you a size, that is a big impairment. The impairment was primarily due to the underperformance of forecasted revenue for the adaptive learning and insights or ALI, and the medical communications MC business segments, meaning weaker revenue will likely occur than previously expected, and therefore you have to impair the assets. And I will end this on a bit of a brighter note. Since there was at the start of this segment, I quickly showed this graph. I didn't have it labeled, but you can see here there was actually a decent increase overnight in stock, and that was actually due to on April 10th, the FDA announced the phasing out of animal testing requirements, adopting AI methods, which does directly benefit SLP, as they do have, that's their whole point, is AI drug development and software development for biopharm purposes. So that directly benefits it. So long term, maybe you do see some benefit once these weakened headwinds, or strong headwinds, I should say, start to weaken. So will that happen in the future? I don't know. But for now, Simulations Plus is our dog of the week.
Yeah. Awesome. And that's the thing. Like, I think that it's an interesting company to, place on our watch list, or place on, someone on your watch list, and just sit in the weeds and watch it. Like Brett said, they've got headwinds. Like the forward valuation right now, I believe, is like 13 times adjusted earnings. So, that valuation might continue to increase if all of a sudden, looking into fiscal year 2026, their earnings, maybe are revised or are lower as well. So, like, this is the thing that you got to balance. But, the company has a great balance sheet, net cash position of, I believe around 26 million. But like, again, another thing to note is that they did cut their dividend in, 2024, from my understanding, due to operating margin weakness. So, that is something that we saw. Maybe in the future, when all of a sudden they don't have such severe headwinds, they will, reinstate a dividend. But again, at this time, I just think, it's an interesting business to place on the watch list and sit in the weeds and see how they progress over the next couple of years.